So, Steve, last week, one of the things that you said kind of struck a chord in me, and I wanted to bring it back up. You mentioned the house always wins. Specifically, what I'm talking about is in reference to we were talking about investing, but we can expand it beyond investing, right? We think about it from an investing perspective. Why does the house always win? In general, why does the house always win?
Because they create the rules. Again, what we were talking about last week was we are talking about investing, where people on Fidelity and places like that, they're like, oh, I get zero trades, $0 trades, no fees. This is amazing. But Fidelity isn't going to let you do that unless there's a way for them to win. Again, you go to casinos, everyone's gambling, everyone's having fun, but the house, look at the casinos. They're gorgeous. Those places are making tons of money. The house always wins. And so, again, it just has to do with who creates the platform, who creates the rules.
So, from that perspective, it's not really about trying to beat the house because you're already playing a stacked game, right? If the rules are made, to be stacked against you, so to speak. But what about trying to become the house instead? What does something like that sound like to you?
That's perfect. That's how you actually create wealth. Instead of, buying into somebody else's system where they're making money, they're the house, they're going to make money one way or the other, you kind of create your own. And it's, I'm just guessing, but that's probably a segue into private lending, because that's where you are the house. You are the bank, where you're the one making the loans instead of the bank.
Well, it's funny that you mentioned that. It reminds me of a story, someone from the UK. His name is Dave Fishwick. Have you heard of him before?
I have not.
Okay. Well, he's actually fairly famous. He's probably more known due to there being a few different Netflix movies that kind of showcase his life story. But what's interesting about him is he's not a banker, or at least he wasn't. However, he ran into some trouble back in 2008. Do you remember what happened in 2008?
Yeah, real estate bubble burst, bond issues, all sorts of things.
Right, this huge financial crisis. And part of that crisis that caused people to worry about bankers specifically, their lending practices. And so Dave, who is actually in the business of being at the time the largest provider of minibuses in the UK, all of a sudden he had customers who wanted his product, but customers who could not actually afford his product without capital or a loan from a bank. And so he therefore had a big problem because without them buying his product, he didn't have a business. And I think that's the most interesting part of the story is that with the bank not willing to play ball, he effectively became a bank. And that's actually the name of the Netflix movie. It was called The Bank of Dave.
Okay.
But the fascinating thing about that story is actually it goes right to one of the things that you mentioned, setting the rules, right? The house wins by setting the rules. And so one of the big things that he saw that I thought was quite interesting, when you think about a traditional bank, what do they look at when it comes to determining whether or not someone is loan worthy in the first place?
So, well, first of all, I'm going to remind everyone how a bank makes money. And just because it's easy, they borrow at one rate and lend at a much higher rate. And so when you say, well, how do banks borrow money? When you make a deposit and you earn 0.1% interest, essentially you're loaning the bank money. Maybe maybe you got a CD that's making 3 or 4% interest. You're loaning the bank that money at 3 or 4%, and then they're going to turn around and loan that bank that money back out to someone else when they buy a car at 7 or 8%, or on credit cards at 22% or whatever. So that's how a bank makes money on that spread. And so, but when you talk about being the bank, what is it that the bank is looking for? People who have the ability to repay that debt. So they're going to look at your credit score, your assets, how well have you paid back your other debts? That's the type of things that a bank is going to look at before they're going to make a loan to you.
Right. That's the call it the traditional risk criteria that a bank is looking at. And certainly underwriting, right? Every bank is focused on that. Certainly they don't want to have, as much as possible, they want to avoid having loans that aren't going to be paid back. But what Dave did that was so interesting to me was that he focused not on the traditional credit score. What instead he focused on was, well, wait a minute, are these businesses successful or not? What does their cash flow look like? What do their customers look like? Are they going to be able to pay this based off of the real asset that is able to afford in the first place? In this case, the asset being their business. And what he found was that this was something that the bank had completely missed. And so he lended based off of the operating cash flow. And, even though it was a financial crisis, within that first 6 months, he didn't have a single company that actually ended up defaulting on the loan. So it was a huge success story from that perspective. But cash flow is something that we talk about quite a bit here on this podcast. And, from that perspective, if we think about it from a private lending perspective, what is that sort of scenario that the lender is looking for in terms of cash flow?
So, you ask who is a good candidate to be a private lender, and it's people who want cash flow. Now, when we talk about cash flow, there's different types of cash flow. And so there are some cash flow where, hey, money's coming in, could have a little bit this month, could be a lot next month, could be nothing for 3 months. So it's volatile cash flow. And you've also got some cash flow that's more fixed. Hey, we know it's this much every single month. And the volatile cash flow, or maybe variable is a better word, you don't know exactly how much it's going to be, but a lot of times it's going to be, you've got a little bit more risk, but you're going to have more reward to compensate. But when you get to the fixed incomes where you know how much is coming in, you can still make 12% or more on that money, but it's coming in on a more predictable basis. And so the people who are either retired and say, hey, I'm living on my income, I need to know how much I'm going to get, or maybe they're getting closer to retirement. Maybe they're in their 50s and they're thinking, hey, all right, I used to play around with some volatile, stuff, some riskier things, but now I want to kind of be a little bit more conservative. I don't want to risk my principal, but I still want to invest in things that are going to give me a good return. That's a great candidate to be a private lender. Again, and stop and think about that. The stock market averages 10% a year. If you look at the 20, 30, 50-year averages, it's like 10% a year. But it does it with a lot of volatility, ups and downs, and it hopefully will average about 10%. You could actually get 12%, beat the stock market, but without the risk. Without the ups and downs, the unknowns. Is it going to drop 20% in the next quarter? Who knows? No, you're getting 12% fixed, and that's a great part for most people to add to their portfolio. So those are the types of people that are good candidates to become private lenders.
Well, and one of the things that I'm thinking about, just to wrap up Dave's story with Dave, right? He had the double win, which is even more fascinating. He, by giving those customers loans, right, he was able to get cash flow from that. But he was also able to sell his original product as well.
Right.
And so it was effectively multiple sources of income. But I think there's one other important part there when it comes to looking at the overall risk criteria to think about that trade-off between risk and reward that is unique about private lending versus other types of investing. And here's the thing, if Dave's customers had defaulted, he could have just gotten the minibuses back, right? There is a real asset that was backed by those loans. And how does that relate to private lending in general? Is there anything you'd say about that?
So there's different types of private lending, and one of the most common is private lending for real estate. So yes, if you're private lending for real estate, then that loan is going to be backed by a physical asset, by a house, for example. And so what you do is there's something called loan to value. And so if the house is worth $100,000, you're not going to loan $100,000. You're going to do a loan of, let's say, $75,000. And so that's a 75% loan to value. Why is that the case? So because the lender wants protection. If that person doesn't pay, if their income changes or situation changes, whatever changes, wait a minute, they're not paying. Instead of just saying, well, darn it, I lost 75,000, then no, they foreclose and they've got a house that's worth $100,000 protecting their $75,000 loan. And that's the value there of, from a private lending standpoint, is you're making a loan, but it's a loan that is backed by something of value that protects you to make sure that you're going to be getting your principal payment back.
And I'm sure some people might have this question. Is there much of a difference between private lending and, if we're talking about real estate, a hard money loan? Can you kind of describe the relationship between those two things?
So first of all, private lending, it doesn't have to be real estate. And so private lending is a broader, you can do private lending on businesses. I know people who do that for inventory. So it's still physical assets, but it's inventory instead of real estate. Or you can do other types of business loans. So private lending is kind of a bigger umbrella. Within that is real estate. And so within that, that is protected. But the hard money loan, that gets a little tricky because there's what it means, but then there's what it's become. And what I mean by that is hard money loans became popular, 20, 25 years ago when people were doing a lot of flips. And it was literally a loan that we don't care what your credit score is. We don't care what your background is, what your payment history is. It's a loan based on the hard asset, which is the house. So we don't care about any of that stuff. As long as the house justifies the loan amount, then we will make that loan. And that's why it's called a hard money loan, because it's based on the hard value of that physical asset. Now, over the years, the banks that do those have kind of morphed, and it's like, yeah, it's a hard money loan, but we want to see your income statements and your credit score and your this and tax returns. And I'm like, well, that's not even a hard money loan anymore. That's just a loan. So there's the term hard money loan should be just a loan based on the value of a home. And so there's a little bit of misnomer there when it comes to what a hard money loan really is. But one of the bigger differences right now is when most people think of a hard money loan, it's an institution. And so there's going to be those underwriting criteria of some sort. And again, private lending, it's a loan from a person. And so, yes, there's still going to be underwriting criteria. There's still going to be factors that they look for, but it's a loan from a person instead of a loan from an entity or a corporation type of thing.
So would your perspective at this point be then that hard money loans really exist in name only today, or there's still some banks or lenders that do them?
A lot of private lenders do. I mean, they're making a loan based on the value of that house. And yeah, they're going to look at the person's experience and some other factors. But the biggest one is, I'm not going to loan 75% of the value of this house. The private lenders are really doing more hard money loans than what most institutional lenders do, because the institutional lenders, they're calling it a hard money loan, but then they're looking at all these other criteria that are not the house. So I'm not sure if that makes sense or not, but
Yeah, it makes sense. I think one thing that people, particularly those who don't have much experience with the private lending world, right? There's two different sides to it. There's the side where you're the lender, but there's also the side where you're the borrower. And so what the borrower might be thinking, if they're not in a position to be the house today, is utilizing capital to open up opportunities where in the future, those opportunities can fund their own ability to be the house or a private lender. And from that perspective, if one is a borrower, what would you say is the trade-off between working with a traditional bank, traditional private lender? Are there pros and cons between the two?
sure. So I got a couple things. We'll talk about the borrower a second, but also I do want to talk about three important criteria from a lender standpoint. But from a borrower standpoint, the advantage of the private lender is there's just less red tape. I will tell you, I've done some bank loans in the last few months. It always blows my mind how many different documents and pieces of paper there are. I mean, I had to sign probably 30 times a disclaimer for this, a disclosure for this, a confirmation of this. There were some that were actually just duplicates, where it was like the exact same document, but they have you sign it twice. And it's cumbersome. And so that's when you look at the private lending, a lot of those, they're cleaner and simpler. They're just easier to do. So from a borrower standpoint, it makes it simpler. You're talking right with the lender themselves. Again, you don't have to go through an underwriting department and an email chain and an online platform where you have to log in and upload your docs. I mean, you're actually talking to a lender. So it's easier from a borrower standpoint. The downside is that you have to find a match. And what I mean by that is, okay, not every lender is a borrower and not every lender has deep pockets. Okay, hey, this lender, they're willing, but they've got $100,000. Well, you need $200,000. Shoot, am I going to miss the deal? You don't know. Well, most of the institutional lenders, they've got deeper pockets. And so you've got less worry about, do I have access to enough money? And so personally, I use private lenders as often as I can, but every now and then there'll be a position where here's a property, here's an opportunity, man, I don't want to miss out on this. And I go to my private lenders and they don't happen to have any capital available. They've already loaned it out. There's no more money. Okay, shoot, I don't want to miss out on the opportunity. Then I'm going to go to a hard money lender, institution, and say, okay, I need to borrow so I can get this property over here. And so they both have their place, but I always go to private lenders first. I just think it's a much better, much easier process to go through. So
Right. Yeah, I mean, that makes sense. It goes back to the rules of the game. Yeah. And I know you had that second point too. I just figured I'd throw out this one comment that, as you're talking, it made me really kind of laugh, right? It's, a lot of people think of a bank, it the marble floors or whatever else. It's that sort of financial entity. But the bank, when they're lending, right, they're not lending its money or their money, right? Technically speaking, they're lending your money.
That's right.
And there's a certain irony to that.
Yeah.
But
So yeah.
anyway, kind of going back to what you
paid
were
for those
saying,
nice marble floors. You did. Yeah.
right? But yeah, as you were saying,
Yeah. So from an underwriting standpoint, what are the risks? And again, this is important for borrowers to understand so you can put together a good borrower package. Okay, what is it the lenders want to understand to protect themselves? Well, as a lender, it's three parts. The borrower themselves. So does this person have experience? Do they have a good reputation? Have they been able to, pay the prior loans, that sort of thing? And so a lender is going to want to research the borrower. They're going to want to research the property. Is this property really worth 100,000 or 200 or whatever the amount is supposed to be? Okay, check comps, check values, check pictures. Okay, yep, yeah, this really is worth enough to justify me loaning that amount of money. So you got to look at the property itself that's securing a loan. And then the third one, it's the paperwork. Again, you have to make sure that you're protected. Is everything filed properly? Is all the wording correct? Is this done in the right way? And what I mean by filed properly, is it filed in the right way that if something were to go wrong, you're protected? And I'll tell you, there was a scam last year. The guy offered really good interest rates. You could, loan money to him, and he's doing real estate, and he was just, doing an amazing job, and he was borrowing money and paying really high interest rates, but he wasn't filing the mortgages properly. And when he started having financial issues, there were properties there, but the lenders had no access to protect themselves because he didn't file the paperwork properly. And so that paperwork legal process, you've got to make sure you've got that down right. So from a lender standpoint, it's the person, the borrower, the property that's securing it, and then the paperwork process to make sure it's all done properly.
yeah, from that perspective, you sometimes see this with any number of opportunities that are out there, whether we're talking about a stock market investment or we're talking about private lending. There's this excitement about the possibilities of making a return or making income. But there's the other side to that, which is really about understanding we're not just chasing returns, we're also trying to control risk, whether we're a stock investor or a private lender. And thinking about it from that perspective, you mentioned some of the criteria that exist to protect a potential lender. Do you want to talk about that in more detail? I mean, I think of things like a promissory note or, other potential lien positions that can exist in something like this. Anything you want to expound upon?
Sure. So I guess we'll start with the paperwork because that kind of explains it. So you typically have a promissory note, and that's going to explain the terms. Here's how much is being borrowed, at what interest rate, for how long, how payments are going to be made. All the terms and conditions, the rules and regulations of the loan are specified in that promissory note. Then you're going to have a mortgage document. And again, here in Indiana, it's called a mortgage. Other states, a deed of trust. There's several other terminologies used throughout the country in different states, but basically there is a document that attaches to that property, in other words, to the property title, so that the owner of the property, they can't sell that property without paying off that loan. Okay. And that's what gives you that security, that protection that, okay, my loan is backed by a property. It's that mortgage or deed of trust or whatever it's called in your state that's going to protect your asset. So that's kind of the paperwork on the legal side. Now, when that gets filed, Dave, to your point, you have what's called a first lien position. So the first lien filed gets top priority. And then after that, there could be a second lien position. Well, they're going to get a second priority. And so if something goes awry with the loan payments and there's a foreclosure, the lender in first position is going to get paid back first, and then the lender in second position, and so on. And so you want to be a higher up you are, the greater the chances that you're going to get your loan repaid. So as a result, the higher you are, the greater the chances you're going to get repaid. That means you've got less risk. And so a first position lender is in a much stronger position than a fourth position lender, and what happens with there's higher risk, it's going to be a higher interest rate. I'm just making this up, but let's say that you got a first position lender and they're getting 12%. Well, maybe the second position lender is getting 15%. Maybe a fourth position lender, that's pretty risky. He's getting 24% on his money because if something goes awry, he's got the least chance of getting repaid. And so interest rate is the most common way of compensating for risk.
It's really interesting to look at this because you really have, the two sides of the coin. You have the borrower, right, which, they're seeing this whole process as the opportunity to get a loan. But then you have the lender, which is really the opportunity to get an asset. And then it's a matter of, to make sure the house can always win, we have to focus on protecting that asset by, doing some of the things that you talk about. And that kind of, makes me think, looking at, this collectively, if you start thinking about some key takeaways when it comes to private lending, if someone is listening and thinking about private lending for the first time, where do they start? Is this something that, they should dive into very quickly? What are your thoughts?
Well, first of all, start in our community. It's why we have Unbroken Investing. We connect people. We connect borrowers and lenders. We put an emphasis on investors, so we're working more with the lenders, but we can help you find borrowers that fit criteria as well. Again, within the community, we connect entrepreneurs and capital. We do, different opportunities. So within our community, we have a platform specifically for private lending. And so if you joined Unbroken Investing, that'd be one great place to start. We got some educational videos in there on how private lending works, some of the process. And so there'd be some things in there you could do, and we could help you out. We've got someone in our team, and that's all she does. She's a third-party vendor that's joined our community, but she helps the lenders make sure that you got everything lined up. So you've got kind of a mentor to make sure that the loans go well. So that's one thing you could do to really protect yourself. Otherwise, you could do it on your own. It's just lots of research. Identifying the right documents to use, how to perform due diligence, how to find opportunities. And again, that could be one of the challenges if you're a lender and not knowing where do you go to even find borrowers. So you can do it on your own. There's a variety of different ways. Again, just one of the points of our community to help people to kind of streamline the process and make it easier. But the next step, it would just be determining if it makes sense for you. That's one of the most important things. And if you are looking for ways to get double-digit returns secured by real estate, then yeah, it might make sense in your portfolio. And just real quick, when I talk about your portfolio, it can also be used in what they call a self-directed IRA. So I've worked with a lot of people that do loans from their self-directed IRA. So they're getting double-digit returns inside their IRA long-term. And so there's different ways you can use it. And so again, the first criteria is just, does it make sense for you to have as some part of your portfolio? If so, then the next step is, well, how do you get involved? And a couple different ways that I mentioned you could do that.
There's a saying that when people talk about, capital in general, right? The saying is opportunity often dies from a lack of capital. It kind of struck me within the conversation today when we think that sometimes there are these great opportunities that are struggling to find capital. And my first question kind of goes back to, well, why is that happening? But then the second part to that is, identifying potentially these alternative sources of funding potentially could have allowed some of these great opportunities to not have died in the first place, right? And so all that said, why do you think that kind of occurs? Is it just a lack of knowledge that private lending is a thing?
Well, there's several things. One of them is, lack of knowledge. And again, that falls into kind of a broader lack of access to capital. People don't know that there's other ways of getting capital. If you think of it I'll make an analogy to investing. A lot of people think investing is I put money into a 401k and I set up a mutual fund ETF account with Fidelity or Schwab or whoever, and that's what investing is. And they don't look outside of that, and they miss out on real estate, on business ownership, on agriculture, on private lending, on crypto, gold, all these other things, because they're very traditional and they're looking at things that way. If you have someone who is a business owner that needs capital and they have that same view, they may say, well, if I'm going to get a loan, I need to go to a bank and get an SBA loan from my local bank. And maybe they try that and they don't qualify. I tried. That's all I know how to do. I'm done. And so they don't know that there's other options for ways to get capital. And so to your point, a lot of it is just knowledge and experience, just not knowing where to turn to find that capital. But also to your point, I've seen many opportunities myself where investors, whether it be real estate investors or business owners, were in a fantastic place to really scale and just really make great money with their business, but they just didn't have enough capital and they didn't know where to go to get it. And so there's opportunities like that. And there's, that's another type of private lending. It's not secured by real estate. And therefore, what did I say earlier? If it's not secured, a little higher risk, you get a higher return. You get compensated for that higher risk. But there's ways of mitigating that risk as well. But there are businesses that are looking for capital in smaller amounts than you might think. I mean, this isn't going to be $1 billion company coming to you for a $50 million loan. These are small loans that can help certain small businesses kind of spur their growth, achieve something, and grow, again, just to take advantage of opportunities.
Right. Yeah. From that perspective, particularly if you don't have equipment or inventory or some other sort of real asset backing, that kind of makes me think of Shark Tank, right? Where you're focused on equity as kind of something that you would focus in on, for that correct balance between risk and reward. And from that perspective, even though we've talked about private lending a lot today, to some degree, this is not really just a discussion about lending. It's really a discussion about thinking differently and some of the opportunity that's out there, potentially right under people's noses. One of the other things that you said that struck me is you talked about it's very common for private lending to offer double-digit returns. Historically, how does that compare to the stock market?
Like I said, the stock market, historically, the index funds, the S&P 500 index, it's been about 10% a year over the last, 30, 40, 50 years. There have been periods in which it was better, periods in which it were worse, periods in which it was worse. But the average has been right around 10%. And so if you can earn 12% and not have the volatility, for many people, it's easier to sleep at night. You don't know, you don't fall asleep wondering, well, gosh, I wonder if it's going to crash tomorrow. You know what you've got, and you know what you're going to get. It's a fixed return. And so there's a lot of appeal to that for a lot of investors.
It makes a lot of sense. One of the things that, just thinking through it as we kind of wrap up today, is the reality is that most people spend their lives paying interest for something, whether it's a car, a house, in the latest iPhone, right? But, if we talk about trying to think differently and going from the perspective of, consumer to investor or lender, wealthy people also eventually start collecting it. That's part of the opportunity paradigm shift, is going from paying it versus collecting it, because you've essentially become, part of that bank. And, it's from that perspective, I look at it and I say, well, maybe the lesson isn't that the house always wins. That can very well be true, but it's more from the perspective of the lesson is that eventually you want to be part of the house. And from that perspective, Steve, what are your final thoughts today?
It's to take a look at it. Consider it as something that you may want to add to your portfolio if you're not already. Again, every single private lender that I've ever worked with made their first one at some point. Again, you got to start somewhere. And it is probably a fit for most people at some point, depending on your age and your risk tolerance. If you're like, those returns aren't good enough for me, I'm more aggressive than that right now, that's fine. But as you age, as you acquire more money, people tend to become more conservative. Okay, now that I got a big chunk, I don't want to lose it. What's something I can invest in and get a double-digit return and make sure I'm not going to lose money because it's protected by real estate? Private lending. And so it's something that at some point in your life, it's going to be a fit more than likely. And again, just depends on, your risk tolerance, your profile. But for most people, it makes sense in their portfolio.
Right. At the end of the day, part of, this conversation is about understanding the role capital plays in creating opportunities. And this lending in and of itself can certainly be part of a diversified portfolio. And from that perspective, we look at it like that. Wealth isn't just about making money, it's also about deciding where that money goes. And with that said, certainly we'll be back again next week. Steve, any final comments, or should we shut off from here?
No, that's pretty much it. I think we've covered it. Great questions, Dave. I appreciate it. I enjoy the topic, again, because I've done it so many times from both sides. I've been a private borrower well over 100 times on different loans, and I've been a private lender several dozen times on different properties. And so I've done it from both sides, and there's a benefit as a borrower and a lender. And again, I encourage people to at least take a look at it and consider it. If you have any questions about how to do it, let me know. And again, especially, the business lending part is something that most people didn't even think of. Like, yeah, private lending on real estate. Well, yeah, you can also do it on businesses. And I've got in our network, if you look at what I do, I connect people. And so I've always got people who are looking, to borrow, people who are looking to lend. And so if you're interested in being either one of those, reach out to me and I'll see if I can help you make that connection so you can take advantage of some opportunities.
Great. As always, Steve, thank you for your time today. We'll catch you guys next time.